Hi, everyone. This is Jason Burek of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He is a former hedge fund manager and author of multiple stock market books. He just restarted his newsletter, Addicted to Profits, over the summer, I believe, where he specializes in global macro, risk reward. He uses the Sir John Templeton method of investing, and also he's an excellent options trader. Dave Skarica, thank you for joining me again.
Yeah, thanks for having me.
So, Dave, I want to ask you about how much ammo the Fed has left for rate hikes. Do you think the Fed's going to keep hiking for a little bit more, or do you think it's starting to come to an end soon?
Oh, I think we're almost done now. And I was pretty hawkish and pretty bearish last year, but I think there's two things you have to look at. Like the 10-year bond in the U.S. is 3.50. It's tough to raise rates to 7 or 8% if the 10-year bond is yielding half of that, right? And then secondly, it's just the amount of debt in private sector, in terms of corporations, individuals, and of course, public sector with the government. You can't really have 7 to 8% interest rates now. So my feeling all along was they would probably go to 4 to 5%. And it looks like they're going to do a quarter at this meeting and then a quarter in March and then basically be done. So I think they're basically almost done. But on the flip side, in terms of talking about them being dovish, I think that they're going to keep at this level, unless some kind of big disaster happens in the markets or credit markets or whatever, probably longer than people think. Like they're going to raise it to, the Fed funds to, 4.5 to 5%, and then just sit there, for 6-12 months and see what it can do. But the issue they're going to have is a lot of the inflation, you retweeted something I did today, on the price of eggs. It doesn't matter how much you raise rates; it's not going to bring down the price of eggs. And if everyone goes to a convenience store, or shopping, a supermarket, or a food shopping, whatever it is, we all know that once your steak goes up to a certain price, or chicken, or whatever you're buying, fish, etc., it's never going to come down again. So a lot of these prices, and that's the problem with inflation too, by the way, is even if inflation, goes down to 2 or 3%, well, that's still 2 or 3% growth over this huge inflation you've had, for years now. That was the one thing, even when inflation came down in the 80s, you were still getting 3-4% inflation in the 80s. And that was after numerous years of, double-digit inflation growth. And that's why, the currency essentially goes to zero. And I'm not talking about the US dollar index. I'm just talking about, I think the US dollar is now 7% since the Federal Reserve was invented and, or started in 1913. It's that will be the issue going forward. And that's the problem with these rate hikes is, because there's supply shortages due to COVID, due to, the stupid policies that have been, implemented. And, it doesn't matter how much you raise rates, that's not going to end. And then there's this whole thing too, where housing in the United States, Canada, most of the Western world went up like crazy under zero rates. And it's so overvalued at this current rate. I'll give you an example. My house here in the Bahamas, which I bought pretty cheaply for about just over 300 grand. I figure it's worth 3 times that, judging by what's sold in the area. I paid my mortgage off a year and a half ago, so I don't really care about selling it. But it's that's crazy. That I just bought I only had a 10-year mortgage here, so I bought it in 2011. It's now early 2023, and this thing has tripled in price. Well, if I had to pay double or triple the rate of 5 years ago, it'd be very difficult to pay, and the price has tripled. That mortgage. So I think that's another issue they're having too, is that because you inflated all these bubbles, these higher rates, they're going to bring down some of these other asset prices as well. And I think what's happened now is we're kind of in this final stage of a credit bubble where people are just maxing out credit cards. There are some wage gains going on now because inflation has gone higher. So, maybe people are making a little bit more money, which has helped cushion some of that blow. But I just can't see an easy way out from all these higher prices and higher cost of living, and it's just it's really ruined our standard of living. Forget the markets for a second. It's just, you think about the post-World War boom in the 50s and 60s and how cheap things were and how plentiful things were. And, now we're talking about $4 or $5 for a carton of egg, or sorry, like a pack of eggs, like 12 eggs. Like, what the hell happened? And it's just like, you always see those old McDonald's, menus from the 60s or 70s, and a burger's, like,
Under a
30
dollar.
cents.
Yeah.
Or or $1 or something. Like, it's just like, what you're like, it's what happened? It's just, so these are all problems. And I don't know if, and a lot of those problems, higher interest rates don't solve. And obviously, we both know that if there's a financial problem, they're just going to cut rates and do QE again. And like even though, like, for example, in Japan, where they've let the 10-year bond go back up to half a 1% in yield, well, they're buying the bond to keep it at that half of 1%. So that's the problem. Is once rates get so high that it could make maybe the government potentially insolvent, they're going to buy bonds to to keep those rates at a certain level. So they may not cut rates, but I could see like the next form of QE could be money printing like that without cutting rates. Like just trying to keep rates at some kind of level.
So the main focus then would be buying government bonds because there's not the demand for government bonds to try to cap rates. So basically then you've reached the end game of yield curve control and Japanification, because even Japan seems to now finally hit the wall. To add to your points there, I think Japan can't even afford 2% or 3% rates because their national debt is so large.
They'll be bankrupt at that.
Yeah, and the Japanese people don't have enough savings to subsidize the debt. I mean, Japanese banks, Japanese pension funds, they're super saturated with Japanese government bonds that they've been buying for the last couple decades. I think it's over 3 decades now. We're recording this interview, by the way, on Wednesday, January 25th, 2023. So, Dave, I want to get your thoughts on Q4 2022 earnings. So with these higher interest rates, I don't think it's fully priced in yet to the entire economy, to real estate, to corporate debt. So do you expect then that earnings, we got a glimpse of this with Microsoft's earnings this week already. They were below par. Do you expect earnings to be bad? But I think you also said before we start recording that you don't expect stocks to, you don't necessarily expect stocks to crash in the short term though.
Yeah, I just because I look at a lot of indicators, and I was extremely bearish last year. And then about October, November, I took off a lot of my bearish bets, because seasonally we were in obviously a positive time frame. The fourth quarter usually the market does well. But you could see a lot of stocks starting to act well and sectors starting to take off. Like, SMH, which is the semiconductors ETF, broke its November, December high in the last few days as before we're going to this. So you also Martin Zweig, who said, don't fight the Fed. Actually, his number one rule wasn't don't fight the Fed. That was his number two, was don't fight the tape. So it's like a lot of this stuff is acting very well. And I'm just kind of like, I don't really want to get in front of it now. And because the market has acted well, like, look, a lot of that decline late last year after the, rally in like October, November, it was in the big, large caps. And actually, I owned shorts on, Apple and Tesla. And I completely took off my Tesla short at 120, right? So it's just like, I look at a lot of this stuff right now. It's just like it was those big, large cap tech stocks kind of driving the indices lower, but a lot of stocks were acting well. So I just don't know, like this quarter or next quarter or whatever it may be, like if the market really rolls over here. And part of the reason is I think we get near the end of those rate hikes and maybe people get all enthusiastic. Oh, the rate hikes are over. And then maybe the next leg lowers because it's like, oh, the rate hikes are over, but these higher rates are here to stay until there's some kind of big calamity in the stock market, right? So, and I agree with you on corporate earnings, but you just don't know what's going to happen, because I know, like, I've watched buybacks for years, and I was like, oh, now that this cheap corporate debt is over, like, you go look at the LQD, which is the the bond. It's had a nice rally in the last few months, but it's down a ton from its all-time high. That's the corporate
similar to junk bond. Is that the higher quality corporate debt?
That's
than
investment
JNK
grade. That's investment grade. Yeah. So it peaked around 130 and it went to 100. Now it's bounced back to 110, but it's still 20 points or roughly 20% higher. It's 20% lower than its all-time low last year, and or all-time high. Sorry, in 2021. And it's like I thought, okay, buybacks are going to dry up because, like you said, corporate debt's not as cheap. but buybacks for the first quarter are estimated to be at an all-time record high. And, companies' earnings and revenues are slowing down. Now, maybe the lower US dollar the last few months has maybe helped the top line in some of these companies a little bit, but it's like I expected a much, and maybe it's because the economy is not growing. And it's like, oh, we're not going to invest in R&D or anything right now. We'll just buy back stock because there's nothing really to invest in. So maybe that's part of the reason. I don't know, but like,
or it's a scam where the people at the higher ups of these large corporations are doing the buybacks because they know they have to unload their shares as many as possible before the next leg lower. Yeah,
that's why they do them. And I've actually been one of saying for years that buybacks are a scam. I think they should actually be made illegal now because they've defeated the original purpose was like when they didn't do a huge amount of buybacks. You go look at after the 1987 crash, for example, companies all bought back their stock in the fourth quarter because why? Their stock prices crashed. They thought the stocks were cheap. That's fine, right? But to buy back your stock just to inflate your earnings, so you inflate your bonuses, inflate your stock options. That's like BS. Like that's and that.
Yeah,
and that's
I agree. Well, that part of it I agree with because unfortunately, in the U.S., corporate executive compensation packages are tied to earnings per share beats.
Yep.
But I would make the distinction because I'm in the David Einhorn camp because of the way dividends are taxed. Corporate dividends are taxed. They're basically when the retail investor gets their dividends and then pays taxes on their dividends, they're basically triple tax because the corporations are paying taxes on all these dividends and profits, all these things along the way. By the time the retail investor gets the dividends and they're taxed on that too, that's essentially triple taxing. So David Einhorn has said that if the company has free cash flow and thinks their stock is cheap, using free cash flow to buy back shares, it saves on the tax bill. Now, I think the game that's been played, as you pointed out, is the amount of corporate debt. So the amount of corporate debt with about 15 years of zero interest rate policy from the Fed has allowed these corporations to about double the amount of, it's roughly double the amount of corporate debt. And a lot of that debt was misused. It was used for share buyback. So it wasn't used for new products and services, for growth. It was used for share buybacks. And now these companies have lots of debt on the balance sheet. And that debt was not, a lot of it was not at a fixed rate. If it's on a revolving credit facility or other types of debt, that's an adjustable rate. So now these corporations, what are going from 2% to 7% interest payments on their enormous debts on their balance sheet.
Yeah, like if you go look at a website, it's called macrotrends.net. It's an excellent site where you can actually find the amount of shares outstanding in these companies. Like, for example, I'm looking at Microsoft right now, and they had about 9, billion shares outstanding back in, it goes back to 2009, right? And now they have about 7.5. And there's only been 2 quarters in the last 13, 14 years where they've increased the number of shares outstanding. So they have basically bought back shares every year to keep their EPS up for that reason that you're talking about, to keep, the EPS up so people can get bonuses. So the earnings every year look good, like they're growing, et cetera, et cetera. So that's essentially why it's done. Like it's a form of accounting manipulation in a way. So and another thing too is all companies have stock options. So industries we do a lot in both you and I invest a lot in miners. Well, miners have bad years when the prices of the asset they're selling, gold, silver, copper, whatever it is, go down. So they can't buy back stock. And then when the options get exercised, the number of shares goes up. So, a lot of the mining stocks have way more stock outstanding than they had at the 2011 top, in precious metal prices. So they can't really do that. And then if you actually look at some of those companies like Newmont, Barrick, their market caps aren't much lower actually than 2011, but their share prices are way lower. And why it is? Because their stock number of shares outstanding have gone up. But these big large cap corporations that are cash cows like Microsoft, like Apple, they continue to buy back stock to manipulate that EPS. And the main reason they're doing it is like you just said, it's because the corporate compensation is tied to the EPS. And a lot of it's not even, stock options are tied to the price of the stock, but a lot of them have cash bonuses that are tied to meeting the EPS number. So some CEO or director can get, boom, $10 million bonus for hitting the EPS. So why not spend shareholder money?
And this is why, Dave, this is exactly why these CFOs, the senior executives at these large corporations are constantly on the phone or email to the Wall Street investment bank analysts that cover the shares of these companies, and they're trying to get the revenue targets, trying to get the earnings per share targets down so they can beat, so their stock options get triggered. This is how the game is played. It's a messed up game.
Well, also too, remember, like when they buy back stocks, not like they go and do it themselves. They've got a trading desk at Goldman Sachs or JP Morgan or wherever. And those guys, some guys sitting there on a trading desk who's got the money from, company ABC. I'm not going to name exact companies. I don't know which ones. And, the investment bank is getting the commissions and all of that stuff off, basically getting
and LBOs, any mergers and acquisitions, leverage buyouts. So if this large corporation is an investment bank client of one of the large Wall Street banks, then they're a lot less likely if they also their investment bank analysts, the stock analyst at the investment bank is also covering the company, and they're also an investment banking client for leverage buyouts or other stuff, they're less likely to get stock downgrades by the analyst, or the analyst is going to get a nasty phone call or in-person visit or bunch of emails then from his boss, his higher up, if he won't lower the bar then for the EPS target so the large companies can meet. This is why a lot of stocks, Dave, are not downgraded. Although in the last week to 10 days, shockingly, we've seen a lot of large banks and insurance companies, they've gotten downgrades.
Well, which actually is surprising, especially insurance companies, because insurance companies should actually be benefiting from higher interest rates, right? Because a lot of them invest in longer term products, and what the insurance companies do is they get that income, that revenue stream from interest, and then they use that, on the money that you give them to generate cash flow and be able to pay out the insurance. So that's actually surprising. And I know one problem that insurance companies were having, since zero rates was, again, they were getting no return on their capital, right? So, but
they have losses. I mean, if they put on this risk parity or leverage bond trade, right, betting on capital gains.
If they were, and see, a lot of them, what they do, and this, and this was the problem with that English bond trade that went on in September was, if you're buying bonds on leverage, that you're like, oh, we're only getting 1% a year. We got to get 5%, to make money in our pension fund and our insurance company, whatever. Let's leverage it 5-1 then. Well, if the bond goes down, 10%, you've lost half your money. Yeah. So that's no, I'm serious. And that's a huge problem.
I'm laughing at they only looked at the reward part of that trade. They didn't think about the risk. If the Fed, this is why since 2008, Dave, every rate hiking cycle that we've had, whether it was the repo madness crisis or the most recent rate hiking cycle, I mean, things blow up bad because of the leverage on these trades.
Well, and another thing too about that too as well, is you're talking about the leverage, is that there was a mentality that rates were never going to go higher. I'm from Canada originally, and obviously Canada's had this huge real estate bubble, and you were like, well, why would someone buy a little shack in Toronto for $2 million? It's ridiculous. But it's because someone who did that and has $1.8 million, $1.9 million mortgage, just figured, and a lot of mortgages in Canada are done on line of credits, which are even, the variable and they're even lower. A lot of them, line of credits, you don't need, a down payment. It's you're buying the house and it's just that, and you don't need to do principal. You're just paying the interest every month. And it was just rates are never going to go higher. That's what they were told, and they believe that. There's protests in Canada sometimes right now where people who bought houses at the top on these kind of loans are protesting interest rates going up. I really don't give a crap. If you're that stupid to buy a house that overvalued on a line of credit with an interest only, with a, and with no, you're not paying principal and you're only paying interest. If you lose everything, I really couldn't give a shit.
Well, you were telling me for years how there's been lots of home equity loans in Canada.
Yeah. That's what I'm talking about, the line of credit stuff. So and home equity. So what happened in Canada was, I noticed living in the Bahamas, when I would come back from Toronto, my parents live in that area. It was the flight is always full. I'm like, doesn't matter. When I first moved here in 2005, it was kind of it's only full. I remember flying down here June 2005 to look for a place to rent, and the flight was like whatever, a third empty, or just a third full, 2/3 empty. And then I was just like, now in the last like say 5-10 years, I was always like always full. And then I realized what's going on is it's like those home equity loans. It's like, oh, someone bought this house for 300,000 10 years ago or 20 years ago. Now it's worth 1.5 million. Yeah, why not take a couple $100,000 out of the house? You're only paying 2% on it on the line of credit. And out of that couple $100,000, let's take 5 or 10 out and do a vacation in the Bahamas or vacation in Florida or South America or Central America, whatever it is. So a lot of that has gone on in Canada, and I'm telling you, like, it's houses that like and we're not talking a huge amount of time. We're not talking 40 years. We're talking 10, 20 years have gone from a couple $100,000 to a couple million. So then people will take equity out of that house, especially when the line of credit loans were very cheap, from, whatever, 2017, 2018 to 2021. And the issue with that now is, though, because line of credit loans and home equity loans are just like pure variable rate. So, of course, now those have gone up a lot. And I think actually today, the Bank of Canada, the day we're talking here, Wednesday the 25th, raised rates another 0.25%, which probably means the U.S. is going to follow suit in a week's time.
I think home prices are down on average about 30% in the Greater Toronto area. So do you expect then a further real estate crash in the major cities in Canada, the metro areas, and then maybe also with the higher rate hikes, the Fed rate hikes, if the Fed either continues to raise interest rates a little bit more or keeps them there, do you expect this to eventually result in home pricings crashing in the United States and also commercial real estate crash?
Well, I think home prices in a lot of the U.S. areas are down a lot too, but definitely Canada is even more overvalued. So yeah, I would expect that. So what Canada's trying to do, they're trying to fight that with like mass immigration, but the problem is a lot of the immigrants don't have money. They're trying to almost create a housing shortage in a way where all these people come here. And it's like, where are they going to live? And that creates demand for real estate. So
did Vancouver just pass, correct me if I'm wrong, but didn't I just hear in the last month or so that Vancouver was debating passing a new law blocking Chinese people that have a lot of money from going and buying more houses in Canada?
Yeah, but that's different because that's foreign money. I'm talking about actual like landed immigrants, right? Like actually people that are moving there, living there, working there. So that's what Canada has. Like that is foreign investment. So yeah, they blocked that, but there's so many ways to get around that. You can, like these Chinese rich families, like your sister's living there, your cousins living there.
You send a college kid to Vancouver.
Yeah, your daughter's living there, going to college.
You make like a shell company. Yeah, you make like a LLC shell company, and you give them a couple $1,000,000 and say, oh, you can start a bricks and mortar business that lose money, but really it's the extra money's to go buy real estate or something.
Like they were finding people in these $5-10 million mansions in Vancouver. Like it was like some 21-year-old girl going to college. Just like, so obviously, how did she get that money? Like she obviously had a very well-to-do family in China, et cetera. Right. So it's like there's ways to get around that and et cetera. Now it's really priced out the kind of like average Canadian. And the thing about that is like, with all due respect to my native land, like, you look at California or Florida and these places are overvalued. It's like, yeah, but the weather's good and you got the beach and you got sun. It's like in Canada, the weather's crap, and the taxes are high. It's like, I'm like, who the hell would want to buy a $2 million dump in Toronto or Ottawa or Vancouver? And I'm sorry to my friends in Vancouver. Vancouver's a beautiful city, looks wise and geographically, but Vancouver's weather is not nice. It rains most of the year and it's around 40 degrees half the year. So it's just kind of like, it's like, imagine you lived in Seattle and you thought Seattle, the weather was good. Like that's the way a lot of Canadians look at Vancouver. But anyhow, so it's just like, anyhow, I think it's going to go down more. I don't think this attempt to kind of prop it up or hurt right now. I think you have the denial stage going on where it's like, holy crap, my house is down 30%. I thought it would never go down this much, but they're going to cut rates again. People are like, I think a lot of people don't realize both in the US and Canada or Australia or England or a lot of these places where real estate really went up in the last 10 or 15 years is they think the anomaly is now with rates being at 4 or 5%, which is like means mortgages are 6 or 7%. No, the anomaly was rates being at zero and a 10-year mortgage being 2 or 3%. That was the anomaly, and we will never see that again. That was a secular top in interest rates, right? Secular top in bonds, secular low in interest rates, similar to what you saw in the late 40s after World War II. So, and I think but the difference back then was there was no consumer debt. Now the whole economy is bent on consumer debt.
Yeah, I would agree. Also, if I could add some points there, I think also another factor that a lot of homeowners aren't factoring in is if they locked in a low mortgage payment, say like with zero interest rate policy, they refinanced, they paid a high refinancing fee and locked in here in the US a 30-year mortgage at a much lower interest rate. If they're going to sell that property, and they probably should have sold it already, but if they're going to sell it, they'd have to go and get it at a much higher, even if you have a perfect credit score now, you're looking at least 7 or 8% interest rates on your mortgage. So a lot of people aren't going to be selling now because they don't want to have to go and buy another home or condo at a much higher mortgage payment. And then I think also, unfortunately, in the environment we're in, it's just the brazen attitude of these politicians and bureaucrats. They think even if real estate prices crash, that people will not object and will not shy. They will be able to get away with, instead of cutting government spending, they'll just be able to raise your property taxes. So I'm just hearing stories about like politicians and bureaucrats in many areas talking.
They're doing that in Toronto right now. And a lot of people are like, what are you doing? Like, we're getting this big correction in the property prices and you're raising our property taxes and inflation's out of control. So our cost of living's higher and it's going to kill a lot of average people,
This is stagflate tax lie, my friend. Unfortunately, I've looked at financial history, and it's normally the government doesn't cut back. The government comes up with an excuse to do more currency debasement and increase taxes one way or another. Either they layer on new taxes or they increase existing taxes. This happens throughout financial history, whether it was a war or another government or another financial problem, normally caused by the government or a central bank with an excess credit bubble or destruction of the money supply.
Yeah, exactly. And you go look at like interest rates too, in terms of the actual rate and what people are paying. Like they're back to like 07, 08 levels. Well, property prices were a lot lower in 07, 08. So again, like I think affordability is near like all-time lows. Yeah, and governments will always do that. Like they're whatever. They're the lowest of the low. Like they'll.
Well, they're changing the inflation data now. They're changing the inflation data now here in the U.S. I think they're going to talk. They're already talking about new formulas to the CPI, and then they're talking about changing what type of data.
And by the way, they'll do that. They'll do that with growth too, because I know in Europe, like in a lot of European countries, for example, like drugs and prostitution are legal. Like in Italy, they are, right? And Italy's had no growth for decades. So one thing that they did in Italy was, that became part of the GDP calculation. So like we both know, like taking drugs or going to prostitutes is not exactly like, productive. But if people do it, that increases the GDP.
Yeah, I remember them talking about PhD economists in the European Union and the European Central Bank years ago. I think it was around the Greece crisis or maybe a little bit after that. So 2011, 2013, somewhere in that range. They were talking about adding an estimate on prostitution to their GDP.
Yeah, no, that they've done that a lot of. Like I said, they did that in Italy, so they've done that in some places as well. So
yeah, I don't trust these PhD economists working for the government or a central bank.
Yeah, so exactly. So that's what they'll always do: the massage the numbers to make inflation lower, to make GDP look higher, to make unemployment look lower. Like the perfect example of unemployment, and this is the case in most of the world, is that like it's not really 3% because the participation rate has collapsed. And then, then you also have like these people, like, what's the difference between someone on unemployment insurance and someone on welfare? There is no difference. But the welfare people.
Or people who stop qualifying anymore and like they're spending 10, 12 hours a day sending out resume emails. Yeah. And the government doesn't count them anymore. And they're still desperately trying to find a job.
Go to Los Angeles or San Francisco, the people living in tents.
Yep.
Who are never going to be part of the workforce and, they don't show up in those statistics. And so we all know that this unemployment rate, it's not the 1920s or 1960s, like 2%, 3%. We know that it's not that. We know that it's really 10 or 15%, but all the numbers are massaged and changed to like show that it's really a lot,
Well, the
And by
government's
the way, like you see that too, because when you go to different countries, right? It's like in the US, it's supposed to have like this booming economy right now, but you see all that crap with people living in tents and they're totally homeless and this and that. Like I can tell you, the Bahamas is not an overly rich country, but you won't see that. Okay, you see some homeless, but you won't see that crap here. So maybe the Bahamas official, unemployment rate is 10%, but in a lot of ways it's lower than the US because they actually, that's a real unemployment rate. It's not like the stuff that's like,
well, they can't abuse the government bond market, and they don't get the high credit rating because the U.S. military and all the other privileges of the world reserve currency. So they probably have to be more honest because they can't get away with as much.
Yeah. That's the other thing too, is like, well, like the US, we all know is the reserve currency of the world, but all these Western countries get that, right? Because the European Union, most of the countries get low bond yields because, that's essentially the second largest economy in the world if you put it all together. China is always debatable, but like if you actually put the whole European Union together, so they have those low rates, and then the Western world mostly has those low rates, so they all can do that. Where like a lot of these smaller, poorer countries can't.
Well, I think the European Union's paying the penalty for their negative interest rate policy and all the problems that they had over the last, really since the 2008 financial crisis. I would argue that a lot of the European banks and the European Union essentially collapsed, and they've been getting a lot of Fed bailouts since then with a lot of rules changes. And then the European Central Bank, on a percentage basis, did even more balance sheet expansion in QE than the Fed did with bond buying for corporate debt and for government debt. And then, ridiculously, they went to a negative interest rate policy where people were putting their cash in bank accounts and they were getting charged a rate to keep cash there, which was even more ridiculous.
Again, that's kind of now there's like no bonds anywhere in the world, by the way, that knows negative interest rates. And I think it was up to 15 or 20 trillion in 2020, 2021. So I think that's a failed policy now. I think that's a policy that like they were trying to do that to stimulate growth. Like, oh, no one's going to keep their,
and now look, 3 years later, because of all the stimmy
look at
checks
Germany. Germany had 0.5% negative rates on their 10-year bond, and now German bond is over 2%. So
well, it's still below the real inflation rate. Yeah, I mean, it's still way
never
below
going to
the
go. Yeah, but it's never going to go to. What I'm saying, it's never going to go negative again. So.
Do you think then inflation has peaked globally? Because we're just hearing that relentlessly from a lot of these global macro guys, these PhD economists who used to work at banks and now they're global macro newsletter writers, and they have like 300,000 Twitter followers. And they're just, they pick and choose, they cherry pick, they pick and choose their data points. I don't know who does grocery shopping for them. I don't know if it's their sugar baby or their butler or their maid or their wife. And they don't care what the bills are because they're making 30 times the amount of money I do for doing global macro coverage on their podcast. But they just don't seem to care that their bills are going up for groceries and rent and all these other insurance costs. I mean, that the CPI is not covering insurance costs. I mean, people's insurance bills are going through the roof now.
Well, I think that's the issue that we just talked about. Like part of the issue, the way inflation's calculated is, again, being year over year, is like if you get 2 years of 15% or say 10% inflation, it's 20%. Well, like, okay, like I'm doing roughly because compounded it's more, but it's just like, well, the next year is 2%, 2% on that 20, is
well, the base effects would say then
the base is like so much lower, right? So I mean the base is so much the original base is so much lower than what you're paying now. That's why those McDonald's hamburgers never go down in price.
But if you're a business owner, you're getting killed on your profit margins, your input costs, most of them are still up enormously over the last couple of years. I mean, like if you talk to an actual person running a business, not a PhD economist or a global macro hedge fund manager that used to work at a bank for 10 years and went to the same business schools or economics department in Keynesian economics, and that they're saying inflation has peaked. You talk to actual business owners, I'm just hearing like it's a nightmare for profit margins and input costs.
Let's just take the actual CPI, right? And just take that at face value for a second. So the actual CPI, what will happen, in my opinion, because we're going to have a lot of easy or year over year comparisons here, February, March, because that's when the Russian invasion started. That's when a lot of prices spiked, etc. So it may go down to 3 or 4%, but I think we're in the 60s, 70s scenario where there were these spikes, and then because that year over year did get easier, then a year or two where it fell back to the mid single digits, and then it went back up to the late single digits or double digits. And I know the government numbers are bogus. I know it's way higher than that. Forget that.
Well, they were more honest back. To add to your point, I think they were more honest back then.
They're more honest back then. So that's what I see happening is like, inflation could go back down to 3 or 4% on their measures. But the issue you're going to have is, actually, I think it's going to reaccelerate because let's say one reason inflation will probably go down is because there will be a recession. So let's say they got to print money and they have to cut rates again. Then you're going to see another round of double-digit inflation. Remember, one thing macro that's happening now too is we're seeing the end of globalization because a lot of countries, and in my opinion, rightfully so, do not trust China anymore. A lot of countries are going to bring production, and this is actually happening right now back home. But we all know the cost of production in the West is much higher than in Asia, et cetera, and that's going to lead to long-term increases in prices or a reacceleration of inflation. But of course, when you mix that in with money printing and the whatnot, and by the way, money printing is going to have to happen because the baby boomers are all retiring, and the money is not there to pay them out. And just from that demographic standpoint, you're going to have to keep printing money.
Well, unless they do means testing and then they start denying people the Social Security that they paid in. So they've been talking about that. I don't know if they're actually ready here in the United States to do that.
I don't think they're going to do that. I think they're just going to print it. Like you'll get your Social Security. It's just not going to be worth anything.
Yeah, it'll be stagflate tax. They're going to lie about the inflation rate. So that's an interesting point you brought up about the 70s, 60s and 70s with the inflation rate ebbing and flowing when the CPI was more honest. Actually, Jerome Powell recently has brought that up, that he doesn't want to be like Arthur Burns, where Arthur Burns started lowering rates again because he saw that inflation was coming down and he did it too soon.
And by the way, again, that's why I think at some point, like I said, I'm looking at those internal measures, like the advanced decline line and a lot of the breadth measures, and they're really pretty good right now. So I don't know, even with negative earnings, because earnings, usually the market turns up before earnings bottom anyhow. So that's always something you have to take in hand. But and earnings are probably just starting to turn down. But I've also seen, people think, the worst is over, and the market can rally for a few months, in a bear market. So I don't know if we're going to see that right now, in the market going lower, in the short to intermediate term. But I do think because Powell does not want to be like Arthur Burns, like you just said, is that these rates are not going to drop after they peaked around 5% on the Fed funds as quick as people think. And that's what you're talking like the second half of this year or into 2024. I think that's when you could see the recession really accelerate. So
if that scenario continues, then that would be, if that plays out, I would expect then real estate prices to potentially crash in certain markets. So residential and commercial then, and then I would be looking at a lot of bankruptcies from a lot of companies in a lot of different sectors because they're not going to be able to adapt. Their cost of capital is going to be higher if they have access to capital. And a lot of these unprofitable tech companies that never had any profits, those are going to go away. I mean, some of them are already down 70 or 80%. So not Microsoft. So Microsoft will still be in business even if they have bad earnings. Maybe they'll have they'll have to reduce their share buybacks or something like that. But a lot of these tech companies that were inventing their own accounting metrics and then revenue only growth, and then just selling more shares to suckers like pension funds and other suckers, that's going to go away. And we're going to see a lot of bankruptcies. And indeed, I think that would probably be, at least from a financial history perspective, the more bankruptcies from companies in other sectors, that would probably be good for gold demand.
Yeah. And actually, in terms of a trade as like a short, as a short, I would be looking at the home builders in the US right now. Now, I'm not doing that right now, but it's on my radar because I don't even think if rates have topped, that even helps, because the next phase, again, out of the recession is going to be job layoffs, which means people aren't making money, which means they can't make those mortgage payments, which are, by the way, because of higher rates and high real estate prices, are near all-time highs. So I think that the home builders in the U.S. can potentially be great shorts because they've had huge rallies after lows of last year because they're kind of just it's probably an algo trade, like a computer trade where they're trading with the yield on the 10-year bond, which has come down from its peak. So, but at some point, like look at 2008, yields went down, but home builders and real estate still collapsed. So I think that's kind of the next phase. And like you said, I think that this will be more like the early 2000s or 73, 74 in gold. Where remember the difference between the problem gold had in 2007, 2008 when it crashed with the market was gold was going up with the market from 2003 to 2007, 2008. We don't have that right now. Gold after the initial move higher after the COVID bottom 2020 peaked out in 2020, 2021 and then went down entirely during the 2021 kind of boom in the stock market. And then last year when the Fed was raising rates. So I think that gold will be kind of a flight to quality. And even if you're a crypto person, I would think like, which I'm not, but like just, looking at what happened in 2017 to 2019 in crypto, even if you're a long-term bull, you probably now have another like 2 years of basing to do in crypto. So again, gold would probably be a better play here than that as well. So yeah, I agree with you. I think that, and just the price action in gold has been very, very good. And I think a lot of the anecdotal evidence has shown that there's a lot of money moving into the sector as well and into the metal as well. And we're really like the funny thing about gold is we're really not very far off the all-time high. Even though no one's really talking about it, there's no really bullish sentiment on it.
I agree. It's sentiment. So the price is what over 1900 again. I think it's
1940.
Yeah, something like that. And the sentiment is just so negative. I think a lot of it's because the gold stocks are not pricing in anywhere near the gold price.
And by the way, I know a lot of people say that the gold stocks will lead. The GDX has done well, hit a new high, like recent high here today, but it's like they're still not priced for 1900 gold, right? So, so I think that's what I think. But by the way, that's happened in the past, and like that 2000 again, the 2002 gold rally. It was actually 2003, 2004, where 2005, 2006. Those years where gold stocks really outperform the metal. So I think we're kind of in that scenario where, again, because the sentiment is negative, people aren't being aggressive in the sector. The gold stocks are kind of underperforming. But, like we're talking about gold, like you just said, that, 1940, you're talking about gold being 7% below its all-time high. But the gold stocks on average are over 20% below their highs, by the way, of 2020, which is not their all-time highs. That's in 2011. So, which are much higher, but like 20% below their recent highs, and actually about 40% below their 2011 highs. So, I think that sentiment will begin to kind of turn around here.
Well, we'll have to see what happens with the Q4 2022 earnings that come out for the regular gold miners that mine a lot of gold and copper and these low-grade, large open pit mines over the next, month or so, because I think a lot of people are still worried about margin pressure, margin pressure from a lot of these gold miners because they've had a lot of margin compression for the last 6 to 8 months because of diesel, electricity, energy prices. Now those prices are starting to come down, so that should help margins along with gold prices rallying. Copper prices are all still relatively high, so a lot of these gold miners also mine a lot of copper. But I think in a lot of these emerging markets where there's mines, there's also labor costs because there's a lot of protests out in the streets. I think Peru is the newest one where there's potential mine shutdowns now of some of their larger copper mines. I think estimates out that about 2% of annual global copper supply with a lot of silver byproduct could be shut down with some of these protests in the near future. Either they're already shut down or shutting down soon.
Yeah, well, and although if you go look at Southern Copper, that's one of the largest copper producers in Peru. That thing has been on fire. So it's not showed up in the stock price, but yeah. But remember too, though, the one offshoot those countries get is over the last year or two, their currencies are down a lot against the US dollar, right? So it's like the copper price at 420 in Peru is a lot higher now than it was a year or two ago. So I think you have to also take that into account. And the wages are probably not going to go up as much as the currencies there have gone down. So but no, I definitely think, and the other thing too with the commodities is, again, comes back to COVID. There's so many supply shortages because, like, usually, like, when we had that big boom in 2021, in 2021 in resource prices, there would be a bunch of supply on the market and that would flood it, and prices would go down. But because of all the restrictions and all the inability to go in there and drill and mine more, etc., we had these huge shortages in these things, and it looks like China's about to open up again. So like that, these things can all drive kind of demand at a time when like supplies at 420 copper, the supply should be way higher than it is now. Same thing at almost $2,000 gold, but it's not there because of all these restrictions. And then there's also long-term restrictions, like with all the environmentalism and climate change crap and whatever, like all of that stuff, is, a lot of these countries are like, you have these leftist governments who believe in all that stuff, and it's going to bring long-term supply constrictions.
Especially in energy. So you actually brought up like leftist governments, and we wanted to talk about, we were actually talking about this before we started recording. You were giving me some crazy amounts of spending by Germany. I mean, Germany over the winter here, they were importing an enormous amount of coal and burning coal. They were importing wood. They imported an insane amount of natural gas, while they talk about like green energy and ESG, which is either energy spending grift or endless subsidies and grift.
Yeah, the estimate is that Germany, because like a lot of these countries, what they're doing is, like, they've done this in England or UK as well, is that they're like spending money to cap people's bills. So people basically, like I said, don't freeze to death or don't go bankrupt. So what's happened with that is the government's essentially like, paying whatever your bill is over that cap, and it's costing them, okay, like Germany, like their gas supplies are, they really haven't been hit by the Russian war, but they're paying way more for that gas, and the government is subsidizing it. So one estimate is they're spending between 400 to 500 billion euros, which is like 20 to 25% of their GDP, which is way more than like the US or UK or Canada or whoever spent, with bailouts during the financial crisis. So like it's basically like you can't have another 2 or 3 winters like that. You get that and you're bankrupt. So in Germany, that's been very fiscally responsible, much more than the other countries, going back 10, 20 years. Well, now that's no longer the case. So it's just kind of like, then the energy policies are crap in these countries. We know that, like, a lot of them are still apprehensive about nuclear.
Germany shut down their nuclear power plants, right? So some of these countries actively shut down their nuclear power plants.
Belgium did too, and these are countries that all needed, some kind of alternative, with the Russian gas not coming anymore, and they were shutting down nuclear power plants. It's like ludicrous.
And then they paid over, I think, 100% markup for the Chinese to resell them natural gas and liquefied natural gas that they bought from the Russians.
I am incorrect about Belgium, so I admit when I'm wrong, because they were supposed to do that, but they did an about face about 2 weeks ago. I'm just looking at an article right now.
Oh, I didn't even see that.
They extended it. They extended the nuclear plants by 10 years. So they must have seen this is a total disaster. We have to do that. So, but I know, actually,
did you see Davos? Supposedly Davos, there's a screening by an environmentalist. I think it's the director, Oliver Stone. I think he did a documentary on nuclear power, how it's actually good for the climate. So there was supposedly like no seating left because all the Davos people were piling in to go watch this nuclear power documentary that he just put out.
Yeah, well, that wouldn't make sense. So anyhow, yeah, and actually they're saying that they were doing this like because of the Ukraine war, et cetera, et cetera. So, but still, like, again, they're not building new plants; they're just extending these other ones. So, and like I think there was a point when one of those cold fronts hit in December in like the UK, for example, where actually wind and solar went down to only like 3 or 4% of their energy, production. And the reason is like a lot of the windmills and the solar panels, obviously, they don't work in the cold. So
they also use an enormous amount of plastics and rare earth metals. So I mean, like, you're using petroleum products to make a lot of these parts. And
let me tell you something. If you drive an EV, that's the biggest scam in the world, because all of the rare earth metals, copper, nickel, cobalt you need in that car, your gasoline car is cleaner.
Yeah, most lithium mines destroy the environment unless you're doing like a solar evaporation pond, like in Chile or Bolivia, where they have like ideal climate. A lot of because it's like in the salt flats, a lot of lithium mines are actually like destroy the environment enormously. Same thing with rare earth mines.
Yeah, actually, where they store lithium in like the liquid, it's like very toxic. It's like, I'm not going to get into all that sort of it, but I'm just telling you, like,
you're just showing how hypocritical a lot of this stuff is.
And I don't know if you've seen the things on like, those cobalt mines in Africa, right? And it's like just a lot of exploited child labor, et cetera, et cetera. It's just like these, some jerk off in Beverly Hills can sit around driving his Tesla, and he doesn't care that some 5-year-old kid's working in a mine, and
it sounds similar to blood diamonds. Yeah, blood diamonds are conflict diamonds.
It's very similar to that. It's just like it's total, it's total hypocrisy. So, I really don't care about that stuff. Like, in terms of like, and I think actually that's gonna be one of my because the one sector I'm probably not that bullish in mining is lithium. Because first of all, if you go look at the spot lithium price, which only trades in Shanghai, it's up something like 17-fold since 2020. So it's up some enormous amount anyhow. And then I think that this policy won't work because part of the inputs are just too costly. They can't produce them en masse like you can gasoline vehicles. So I think this whole thing where a lot of countries are phasing out gasoline vehicles by 2035, it won't work. And then you'll see them over the next 5 years be like, oh, no, we can't meet that target. And, we're going to put it out to 2020, 2060, 2070. I think that's what you're going to see, And if you live in a place that has like a lot high driving range, like I think it was Wyoming just made EVs, they're phasing out EVs because they're saying in Wyoming, it's rural. You have to drive long distances everywhere. And EV doesn't work here,
There's probably not many charging stations either. So,
yeah. So, and actually, I'll tell you a quick. This is just like an anecdotal, like personal story. I rented a car. I was in England. My dad was born in Leeds, so we fly into London, and then I rent a car to drive to Leeds because of inflation. By the way, there's all these strikes going on. I'd rather take the train, right? Especially after a 14-hour flight with connection from the Bahamas to England, right? But I'm like, well, I got to rent a car because I don't know if the trains are going to be running. And so the guy's like, oh, we got an EV for you, but it only has like, whatever, 200 and something kilometer radius. And it's like 200 kilometers from, London to Leeds. And I'm like, that's cutting it close. And then they're like, oh, it's only half full, like half charged. I'm like, oh, well, I can't get there. So I just said, and then even like if I could get there on the EV, I was kind of like, well, I got to find a charging station. This is a pain in the ass. I was like, just give me a gas car. Yeah. And that's what I did. So.
Okay, so I have a couple more questions. We're over 50 minutes before I let you go. I want to ask you, I know you follow Sir John Templeton, so he's looking for a point of maximum pessimism. Is there any type of commodity sector or country or industry right now that's down 70, 80, 90%, kind of like what Meb Faber, the hedge fund manager Meb Faber, has talked about, that if an industry, the shares are down close to 90%, the odds are very good over the next couple of years that it will have a really nice rally. Is there anything like that? Maybe like how natural gas now at the U.S. futures contract prices crashed over 50% in the last. Is that starting to interest you? Or are you looking at any specific areas right now?
Well, one stock that's rallied a bit, I haven't even talked about it, but I'm just looking at the chart right now, is actually, I love telecom companies. And the reason I love them is that they have a lot of debt, which means they're leveraged, but they're mostly monopolies. So they're never going to go out of business. They're going to get a bailout from the government. They usually pay high dividends. Like TIO, this is an example of what you're talking about. Like, this is the Argentinian telecom company. It went from $30 in early 2018 to $4, and it's at $6.70. So I don't know. I'm not saying to buy it here, but I'm saying that's what you're talking about. After it went down, almost 90%. I actually think the lows were around 350. It rallied almost 100%. TKC, which I only a tiny bit of, which is that's the telephone company in Turkey, has more than doubled from its lows. And same thing, this stock went down like 90% from over $20 and near $20 to $2. Now it's 540. So that's what you're talking about, that sort of thing. I still like a lot of the junior gold miners because a lot of them are down 80 to 90% as well from their highs. Actually, even though like maybe I'm not like hugely bullish on the stock market, with the tech bust last year, there's a lot of small technology companies which were bubbles back in 2021, which were like $50, $60 stocks that have gone to $1, $2, $3. And I think that they are actually good plays. There's a lot of companies trading at like less than revenues, 1 times revenues, which is like really cheap if you have growth on the top line.
Is there a specific tech industry where that's the case? That's 1 time.
It can go anything from like there's a streaming media company. I don't want to give away because that's for my paying subscribers, to 3D printing, to those kind of sectors. And a lot of those sectors, the streaming media company I'm thinking about did go up during COVID because more people were at home streaming whatever, right? But like 3D printing is really interesting because the 3D printing, like DDD or SSYS, these kind of stocks, 3D printing had its bubble back in 2014, right? And these stocks are all off 80, 90%, and they've grown their revenues since 2014, but the stock prices are all down 80, 90%. So now they're trading at less than 1 times revenues.
Yeah, they've had to do that industry. All the easy capital went away, and they've had to do mergers and acquisitions to survive. So they've had to get leaner and meaner. So they've had to get leaner and meaner and focus on more efficiencies lately. So long term, that's good. I mean, they've had their bust, right? They had their credit bubble and boom. The valuations were insane. The share prices, they were selling shares like crazy, and those shares crashed. And now it's a post-hype boom where all the hype is out of it, and then people are just starting to look at fundamentals again.
Well, it's kind of like internet in the early 2000s, right? After Amazon and all those companies busted, it was like, the same thing. The growth was still there, but the stock prices had come down. It was the pros, the easy money, kind of like, like crazy boom. And, those stocks all did really well over the next 10, 20 years. And it's a great industry. Like and their technology is way more advanced in 2014. Like you can 3D print organs, houses, they were 3D printing a lot of the materials used during COVID as well. So like you can do so many things with that technology. And actually, I don't know what's going to happen because I thought the Democrats would have done it their 2 years in power. But a lot of the marijuana stocks, same thing, are down 80, 90, 95, sometimes 99% from their highs back during the kind of the fervor that happened when Canada legalized in 2018. And there was another spike, kind of actually Biden got elected. But remember, with the legalization, say, of marijuana, I don't know if it's going to happen, but the Democrats still have the Senate. And all you need is like whatever.
Are you talking at the federal level? Because at the state level in the recent elections, I mean, like actually more states approved it, but that's going to take 6 to 12 months before more states 12 months.
But remember, like even at the federal level, if they follow suit, all you'll need is 5 or 10 Republicans to come over, right? So I don't know if that's going to happen or not. But regardless,
the major problem is still the cross-state banking laws. So if you're like a local marijuana business, even in the state of Colorado, where it's been basically legal for years now, you can't.
Well, you need the federal legalization to get past that. That's the issue,
Yeah.
So, but anyhow, regardless, remember, most of these companies are Canadian companies anyhow. They've all fallen like Canopy Growth, right? Which is weed.to in Toronto.
Don't they have they have deals with food companies? So they're working on putting like marijuana cannabis or THC into actual food products.
Yeah, like STZ Constellation, which owns Corona, and Robert Mondavi, the famous wine out of California. They have a big investment in weed. And same thing, they're gonna do in like drinks and stuff like that, like Dan Bilzerian,
like potato chips or corn chips, Yeah,
like Dan Bilzerian No, that's what he turned that Bill's company, that they're private now, but that's what he turned it into. He was like, I can make more money doing the infused drinks and that sort of thing than I can off just like selling marijuana. So there are a lot of like, probably that's where a lot of these companies are going to go. But like, again, they're all down 80, 90, 95, sometimes 99% from their highs. And sometimes it's just as simple as, hey, Jim Dines, rest in peace, used to say, don't think, look. And it's kind of like, well, you see that company is down 95%. It's kind of had a big basing pattern. Just buy it and then like forget about it for like 5-10 years or whatever, 2-3 years. And then a lot of times you'll look it up and be like, oh, this is up 5x, because it did have that kind of decline. So, and I still think, even though like I'm kind of neutral in the market the next 3 to 6 months, if I'm going to buy a sector, I'm going to buy something that's really beaten up like that. I'm not going to, for example, like McDonald's is near an all-time high. I'm not chasing McDonald's at $270 a share, but like these sectors that are really beaten up, it's like, okay, a bear market could happen. They could go a little lower, but most of the negative price action is almost into it, So, I actually even think they've rallied here because of the China news. Some of the casino companies on a decline, I would not chase them here, are okay because a lot of the revenue growth comes from Macau now, not from Vegas, right? So I think that if you get another decline in them, they're worth looking at. And a lot of the casinos companies in the U.S., like Penn, for example, are actively now in sports gambling, which is going to be kind of the next big phase of it. And they all blew off kind of like marijuana stocks did when marijuana got legalized in Canada. A lot of these gambling stocks blew off when sports gambling started becoming legalized in a lot of the states. And now a lot of them come down a great deal and the valuations are a lot better.
Yeah, there was no sports gambling during the pandemic because a lot of the sports, I think, were shut down for a certain amount of time and then it restarted. And I think DraftKings IPO'd and then that had a really nice boom and then it's busted after the IPO. But yeah, there is potential for a lot of these online. I think some of the casinos are eventually going to buy some of these online sportsbook companies because that's where the growth is.
DraftKings, for example, has a really good looking chart as well. And you're talking about this, like, yeah, it IPO'd actually right before the pandemic. And then it went from like $15 to like 70. Now it's back at 15. So, and there's been a lot of growth in those like 2-3 years. So like, I'm not like really chasing these things, but these are the kind of things, in my opinion, to kind of look at here.
So risk reward, valuations, fundamentals, upside. So there's decent potential there with a margin of safety because you're not paying $70 a share and you're not paying insane growth multiples.
The perfect example is like you're talking about DraftKings, like, maybe a company like, just using an example, I don't know if this will happen. Like maybe like I'm looking at MGM right now, right? Like maybe it's not that far off its all-time high MGM, right? Maybe a company like MGM comes in and says, hey, that's a great brand. We can use that to also diversify into sports gambling. So let's do that.
Well,
right?
MGM's running TV commercials like crazy for their sports gambling. So I don't know how it's working, but they're at least trying. They're running a ton of... They're trying,
but maybe they'll just say, hey, let's take over DraftKings because that's an easier way to really expand it even more. So at some point...
In that segment, yeah, DraftKings and some of the others are more respected than MGM, a casino trying to do online gambling with
and remember another thing too, one of the biggest issues in that whole online gambling is a lot of times the states, this is not just like, okay, whatever, I'm Budweiser or I'm Miller and I'm going to sell beer, right? Or even like a microbrewery. No, it's like a lot of, and all you gotta do is get your license from the government, pay for that, pay the taxes, you're fine, right? No, it's like a lot of these states only give 8 or 9 companies a license to gamble in that state. So if you're like MGM, you're like, oh my God, we're not going to get into like half these states. Well, let's take somebody over that's already in all of them, So
I think MGM has a lot of local casinos now, so they built a lot of smaller casinos. So I think they could do that. But if that segment is not doing well, I could see them doing some type of merger and acquisition scenario. But this is government picking and choosing winners and losers. They need more tax revenue. So they've already started, these states have already started legalizing marijuana, sports gambling, probably prostitution in the next 10 or 15 years. They'll legalize it.
What always makes me funny about the hypocrisy again in governments, I don't want to go in some libertarian rants, but it's like I get my feed here. There's a service called DAZN, which is a streaming service, and I use that to stream the NFL games, because in Canada they have the license, right? And I use maybe I'm giving too much information, but I use a Canadian VPN, and my dad has the subscription, and so I use that, and I stream the NFL games. And at halftime of the games, the guy will even tell you, like the analysis guy, like guy used to play in the NFL, like, oh, go over under this at half, blah blah blah, like for the second half. And I'm like, what hypocrisy! Like when I was a kid in the 80s and 90s, it was like, no, you never talk about gambling on on those sports casts. The NFL was strictly against it. But now that it's legalized, and
it started with fantasy football, which was free, so that got the camel's nose under the tent, and then they started doing betting on fantasy football, and then it allowed for full betting of all the regular normal bets.
Yeah. So anyway, when I watched, I was just laughing. I'm like, now. You're not only saying like, okay, whatever you can bet, now they're like promoting it on the halftime analysis of the game.
So the NFL, like, I don't know if they're disclosing this properly, but like the television networks like Disney and ESPN, and I think the NFL, they all had equity stakes in like DraftKings and stuff like that. So that's why they're promoting it, man, because they were investors. So like Disney, so the reason like DraftKings, like the sports book and all the betting stuff, they were promoting that stuff so much on the sports news channels is because they were getting just like they were equity holders of like DraftKings and the other sports books.
No, that's what and that's why like alcohol, like I talked about like Constellation STZ. It's the same thing with that, right? It's like, a lot of the alcohol companies were against the legalization of marijuana because they're like, that's competition, right? For people who want to get whatever, like, wasted, right? Like, but now they're like, oh, well, we'll take an investment in it and legalize it. Cause then that's part of it, like Philip Morris has a lot of, they lobbied for years, by the way, against marijuana legalization, right?
And they flipped, right?
And then they flipped. Yeah, they invested in a bunch of the companies and projects because it was just like, well, less and less people are smoking cigarettes all the time. So, let's invest in that, right?
They don't have a choice. They can either adapt or be dinosaurs or be like Kodak camera.
Yeah, exactly, right? Yeah.
They can adapt
Kodak camera didn't Kodak camera do an NFT?
Let's not go there. Let's not go there in this podcast. I don't want to talk about NFTs and cryptos. Yeah. And
hey, if you had the balls, that was a great short at $40 when they did it.
So I want to ask you about, it seems like there's going to be a lot of crazy things with governments and central banks changing policies and tax laws. Could be a lot of asset price volatility. How do you think people can properly manage risk in this environment? Do you think people need to own more cash and gold? Do they need to have tighter stop loss limit orders? Do they need to be more diversified? How do you think people should manage risk in this environment?
So right now, like I said, I'm kind of neutral. So like some of these sectors and stocks I talked about, I'm very bullish PMs here. I think it looks really good. Like the US dollar could have a little, maybe of a bounce here off this oversold position, but it does look like it topped in the fourth quarter of last year. Especially, and it's all like, just to get back to monetary policy, like you're saying, like it does look like UK, Europe, these places are actually in the next 3 to 6 months going to raise rates faster than the U.S. as well. They were kind of behind the curve in raising, so they're going to continue to do it. Where the U.S. is almost going to be done in March. So I do think that once they're done, that's kind of like sets the tone for PMs, because then the next move will be them cutting probably late this year, early next year. So I like the precious metals. And like I said, I think look at when you got these beaten up sectors, these stocks down 80, 90, 95%, whatever it is, you're never going to get the exact bottom. So, and you don't have to be a hero. You don't have to time the bottom perfectly. It's like put your toe in the water, buy a little bit now, buy a little bit more in 6 months, buy a little more 12 months, et cetera, et cetera. Like I just think about oil and gas in the late 2010s, right? Like for example, one company that I had on my list for a while, I don't have it any longer, I sold it unfortunately too early, was Athabasca Oil Sands Company. This was a Canadian company up in the oil sands, smaller like company. It declined from like over $10 a share to like 10 cents in 2020. And I remember buying a little bit in the letter at 10 cents, sold most of it 50, 60. It's now $2.30, but it spent all of 2020, like the whole year basing, and I crunched the numbers. I was like, they're not going to go under, and it was basically based between about 10 and 20 cents, then I just said went up like in the next few years, 10, 20 fold. So that's the one thing about like doing that is like I said, you put your foot in the water or toe in the water, and then you can slowly edge in. You don't have to be a hero. Like for example, I mentioned DDD. DDD actually spiked back. That's that 3D Systems, the 3D printing company. After it went from $100 to about $5, it actually spiked back to $50 in 2021. Now it's back to around $9. So same thing. You just like slowly get in.
Wow, that's a lot of volatility. Sounds like you could do some pretty crazy options trades, volatility option trades.
That would be tough because at the time like you didn't really know that, and it just got taken up with the whole tech rally, after COVID started and in 2020, right? So, but like, you could if you want to do some long-term leaps or something like that, that's another way you could do it if you don't have a huge amount of capital. It's like, buy $1,000 of out of the money DDD leaps that expire in Jan 2025. So it's like you can do these kind of things, and so that would be my advice. Is that but I think one thing that you might want to look on the short side.
No advice. We're just giving opinions here.
I have disclaimers. And on the short side, I would look at anything that has to do with consumer spending, because I just think those higher rates, higher for longer, that's what I've been calling it. That is going to bite the consumer. So I just think at some point, like that's going to bite them, and and when that happens, like you're going to see. But like again, I think those U.S. home builders. I was just looking at a few actually as we were doing this interview, like KBH or DHR, like these kind of things. It's like or Lennar. A lot of them, some of them are almost back at their highs, and we know that housing is nowhere near in terms of activity back at its highs. I just think that they're going to roll over at some point. And again, it's almost impossible to time it, but I would like those as shorts. One company I like as a short, they expanded into restaurants, but you're going to laugh at this, is Rick's Cabaret, right? Longer term, because the first thing guys cut back on in a recession is the strip club, and that's gone from like in COVID that went to $10 and now it's $94. So I like something like that. And it's just because recession, job losses, inflation, at some point this will cut into people's budgets and these kind of things will go down. But I know a lot of people don't like the short, which I don't blame them because I've done it and it's a pain in the butt. But again, the beaten up companies, like those sectors I just talked about, you can pick away at PMs. And by the way, if you're someone who has a large amount of capital, I would have no problem locking into a 2-year bond here at 4.5%, because you were getting zero for a long time. So if you got $1 million laying around, I would take the 45 grand a year right now for 2 years, a year, because I still don't think the markets are going to do that great the next 2 years.
And you've had a lot of experience trading options, a lot of success too. And that's despite what around 70% of all options that are traded, they end up expiring worthless. So
like last year, last year, that's the only thing I made money on, because obviously I own junior gold miners and I had only one bad trade. It was a subprime lender in Canada, Home Capital Group, that got taken over, and I had a put trade, and that basically went to zero. But other than that, but then I made all the money back because I was long Eldorado, Ego, the gold mining company, in a call trade, and then that stock went up 50%. So like I made like basically everything I lost, I made back and more, and actually Eldorado's even up higher, even higher now. So and actually this one of the streaming companies, I'll give it away. Okay, I'll give away something here. So and you can put this in your little thing. So the streaming company I'm doing as a turnaround play right now is Fubo, which does a lot of streaming in sports, and their earnings are going to come out in about a month. Their problem is that they're growing the top line, they're growing customers, but like a lot of early stage tech companies, they're losing a lot of money, right? But they're probably going to have over $1 billion in revenue. The market cap's only about $400 billion. And what I think is going to help them in the fourth quarter was DirecTV had problems with some of the local providers in giving people the access to the World Cup streaming. And because this happened to me, I was using DirecTV's streaming service, and I moved over to Fubo, which I'm happy I did because it's better and it's cheaper. And that's how a lot of Americans stream the World Cup in the fourth quarter. So I think you're going to see a little surge in their earnings in the fourth quarter through, and by the way, the World Cup is usually in the summer as well, right? So this also kind of gives them a little juicer because a lot of people use Fubo to also stream football, et cetera, and other sports, but they also got the World Cup on top of that. And like I said, they lose a lot of money, but I've crunched the numbers. I don't think they're going to go under. And the stock's all-time high is $60, and right now it's $227. So, it's like, why not take a little, take a little
sounds
shot
like
at
there's
it.
blood in the streets with that one. Yeah, it sounds interesting.
Yeah,
They cover a lot of global soccer games. I think I've heard of them before.
Yeah. And like in soccer's popularity is picking up in the States, and Fubo's, if you go say like how to stream Premier League game, almost always it will tell you Fubo, like when you click on the link on the Google search or whatever, and they'll tell you that. So, and like, I'll give you like, I don't know how much this can impact it because my dad was born in Leeds and I'm a Leeds United fan. So Leeds is about to sign. They have 2 players in the U.S. From the U.S. national team, about to sign a third, and their coach is American. So, and the 49ers, by the way, are about to take over Leeds. So I think they're going to promote Leeds big time in the States. It's kind of being like the American Premier League team. And it's like that alone will hey, you can, watch the Leeds games on Fubo, right? And you watch the American, basically national team that's in England. And I think that can like lead to like a little bit of a bounce.
I think the former Tampa Bay Buccaneers owners, either the current or former ones, they bought Manchester United or another team, and that didn't work out. Yeah, they mismanaged.
No, people actually want them to sell it because they've said that they use the Manchester United cash cows, because he owns the Bucks too, like you said, and I think he owns same thing. Well, they're doing well this year, but Kroenke, who owns the Rams, he owned Arsenal, and Arsenal has not been good until this year for years. And a lot of them say they use those English, Premier League teams as their cash cow to like support their other franchises. So then they want them to sell it. But
I also don't think they like a foreigner. I think they also don't like a foreigner owning their team. So
the guy who owns the Jags, he's a British guy too, and he owns Fulham, which is a team in England as well. So there kind of seems to be a lot of synergy, but like whatever.
The Jacksonville Jaguars have been bad for so many years, but it looks like they might have a quarterback now. I mean, the Raiders are going to be in the market for another quarterback too.
Yeah, we're going to sign. We always talk about this stuff off here. The Raiders are going to sign Brady this year, which I hate Tom Brady.
You really think so? You really think he'll play another year?
I think he's going to play another year. I think he's going to play in the Raiders. Which I'm not a huge fan of. But whatever. What can you do?
They need to draft. They need to draft and develop a quarterback.
They're going to draft a quarterback too, but I think they'll go with him for 1 year. Because you have to understand, like this year, okay, we're getting off topic. We're ending off on a fun note. The Super Bowl's in Las Vegas this year, so I think they're going to re-sign Brady and Gronk and try to like take a 1 year run and then have some young. The nice thing about signing Brady, I will say, it's not like the Broncos with Russell Wilson. You're not giving up, or the Browns with Deshaun Watson. You're not giving up a whole bunch of draft picks and screwing yourself for like 10 years. It's like, if it doesn't work out, whatever, you move on and that's it. It's, that's why Brady worked out on the Bucks, and that's why Manning worked out on the Broncos, because they didn't have to give up draft picks, right?
Yeah, so, David is for our listeners who are not aware, Dave is a very passionate Raiders fan.
Yeah, well, they stink. I'm not that passionate anymore. Like, I kind of gave up. I've given up. So, Well, hey, man, you're a big Ravens fan. Come on.
Well, I knew the season was over when our quarterback got hurt. I mean, like, we couldn't score any points, and now the offensive coordinator's gone. So he's been generating bad offenses. I mean, we could barely score any points. We could play defense and run the football. So we were at least like kind of in the games. But if a team scored a certain number of points, then we automatically lost. So
that was a ridiculous way to lose to the Bengals. the fumble at the 1 yard line.
Yeah, well, when you can't score that many points on offense, that's what happens. So like one or two mistakes and then you lose. So that's what you have no margin for error. When you can't score that many points, when you can't get a lot of touchdowns, you have no margin for error.
And yeah, long story short is that Fubo is the easiest way for people to stream the Premier League. And I think with like soccer gaining popularity, and I've read that Fubo wants to expand all over the world. So, they'll probably, and also too, like I said, with the market cap so low, only like 400 million, it could be the kind of company that, like we're talking about takeovers, like some company like Amazon Prime or,
I could see Google buying it and sticking it with YouTube. Yeah.
Well, like YouTube is going to have NFL Sunday Ticket next year, right? So,
Well, they're trying to sell YouTube Pay instead of basic cable for people. So, all these big corporations are all trying to get Apple. I think is even talking about getting more.
What would it be for Google to come in and say, "Hey, like I said, 400 million. Here's 4 billion." Right? That's 10 times. For them, that's nothing.
Well, they did that for YouTube, and they were heavily criticized. But now YouTube's like they're one of their main cash cows.
Oh, I know. Because I've been on YouTube, like not only like producing content like yourself, but like watching for a long time, and it's just crazy how much has grown, right? In terms of the content on there, they have all, like you said, you can get a TV package. You can, they have their own
$30. Yeah, I think it's $30 or $40 a month for basic cable, which is way cheaper than the cable companies now.
And I have the YouTube Premium where you can download stuff off it. It's only $9 a month. You can. When you're on your phone, the YouTube Premium makes it so you can have the box open, so you can be like texting and doing other things on the internet, and it's still playing. And then also YouTube. Actually, my favorite way to stream, buy, and rent movies is YouTube. You just put your card on there, and if you like a movie,
I've done it a few times. Yeah, it's like $2 or $3, so it's cheaper than going to like the old video store. So it's like the digital. I've done a few digital downloads with Amazon and then with YouTube. Yeah, for $2 or $3, it's pretty cheap.
And I don't know what your feeling is on it. Like sometimes some of these TV shows, like I bought the whole Sopranos series on YouTube, right? So I'm like, it's something I really like that. It's like, do I really want to like have 8 trillion streaming services, or do I pay $50 to YouTube and just get the whole thing there and I can watch it anytime I want, right? It's like, to me, it's
or you pick and choose a movie or a TV show. Yeah, you pay as you go. So rather than having a bunch of old discs, I have old CDs here from when I was in high school and college. I have really old CDs around here still too. I haven't backed them up and put them on a hard drive.
No. When they like, if actually, I wish YouTube had more of that kind of stuff on it. No, I have old shows from like, I'm a little older than you, from the 80s and 90s and stuff, and it's like I don't want to like watch my DVDs anymore. I just rather have it all there and stream it. So
you're optimistic. I always now with my guests, I always ask them, since we're discussing like very kind of dismal things with the economy and markets, the bull market, the easy money, the easy bull markets, I think are probably over, at least for the short term. Is there anything that you're actually optimistic on in the economy or in industry or something?
Here's the thing I have to say about the market. If you go look at the charts, there's kind of a potential head and shoulders bottom in the S&P. Especially if it breaks 4,100 and then 4,300, right? Which was the high back in the summer. Mm-hmm. And if that happened, I wouldn't think this would be some great bull market, like the 2010s. But I think this could be a cyclical bull market within a secular bear market, like the 1966 and 1968 bull market, like the 73, 74 to 76 bull market, like the 70 to 72 bull market. So I think that's one thing people always get in, and by the way, the sentiment, if you look at like AAII or some of these other indicators, it got really bad, last October, like way worse than even 2008 or 2002. So yeah, maybe we could see a 1 year or 2, and they're going to want to prop up the market into the election, and it's not even a political thing. They always just want to do that in general, right? Because whoever's the Fed chair wants to keep their job. So
I don't know why Jerome Powell wants to keep this job, though. I'd want to be out. I'd want a golden parachute. I'd want to go do something else and get paid more money rather than deal with this headache.
In a way, the smartest guy was Greenspan, right? He kept doing bailout after bailout, and then he got the hell out right before the financial crisis. And then if you look at Greenspan, if you actually listen to him talk now, he sounds reasonable. He criticizes all the Fed policy.
Yeah, he's back to being a libertarian and talking about stagflation and people need to own gold. Yeah, he's back to kind of being a libertarian, kind of pretending his time at the Fed didn't really happen.
Yeah. So, but it makes sense. I remember I talked to someone who was a big gold bug. I guess we're going to finish off soon. Talked about it. It was like, well, it makes sense because when you're in that position, your job is to prop up the whole system, right?
But then when the dollar, you're defending the dollar
like the whole,
and U.S. Treasuries.
The dollar, the U.S. Treasury, the stock market, wealth effect, whatever economy, and then when you leave, you can say whatever the hell you want. So it does kind of make sense. So what I'm trying to say is, and nothing's ever, because I see these stupid charts, I ignore them on Twitter where people were like, they plot like 2008 tweet, like no bear market is ever the same. So everyone thinks that like this could be a longer bear market again, like 2000, to 2002, like 2007 to early 2009. But it's like, what happens if this is more like 1966, which was about a 10-month bear market like this one, and then there's a 1 or 2 year bull market, not some huge 5 or 10 year bull market like we've been used to. Going back the last 20 or 30 years. And then the market turns down again, when the next rate hike or inflation cycles happens again. So maybe something like that would happen, which is why
a big energy spike because of the supply side problems or food problems. So we have another big energy spike, and then it feeds on itself with more inflation. The consumer stops spending, the politicians panic, and then that causes another problem.
I would ask you this too. Why has oil come down, from 110 to 80, but the XOI is near all-time highs, right? And maybe it's because the stocks or stock investors don't believe that decline in price, partly because that decline in price has been caused by the lockdowns in China, right? And the lack of demand from China. Well, now that's all going to ramp up again, So,
and there also wasn't any additional, very little new supply actually came online. So
because ESG crap, they can't do it. Exxon will just pay dividends and buy back their shares because they can't really have a huge exploration program. They know that, So that's where I won't blame a company for buying back its shares because Exxon did a huge, and I think they kind of did it because probably the Exxon CEO is more like a Republican. I think he did as an FU to Biden personally, where he was just like, because remember Biden was telling those companies, cut prices, don't buy back shares. And then Exxon announced a record buyback. So I think that was a bit of like, you can't tell us what to do, So, but anyhow, like, I think, and you're going to see that too, like in Canada, same thing, like we have the worst prime minister ever, and so basically like Suncor and the big oil sands companies, because it can't really, there's no pipeline. They can't really increase the, production en masse. They're just going to do more stock buybacks and more dividend increases, and that can like prop up the stock prices.
Well, and there's not a lot of new supply coming online. So when the economy does get a proper footing, China comes back online, demand levels are, so China starts to do more plane flights and drive cars again, or move goods back and forth through their economy. That's going to create more usage for energy. So, and then there's not as much supply because a lot of the cheap and easy oil and natural gas supply that's low cost, it's long gone. I mean, the Saudis can increase production a little bit. Some of these OPEC countries can increase production a little bit, but you're talking enormous CapEx bills. And a lot of these countries are not making enormous CapEx investments right now because there's, like you said, restrictions on ESG policies. Or if you're a national oil company in one of these other countries, I mean, they've been talking about windfall profits tax. Whether or not the government actually does the windfall profits tax is another thing, but it'll just spook these executives. If you hear that you're going to get hit with a carbon tax, you're going to be forced to make investments into ESG, you're going to get hit with windfall profits taxes. I mean, these senior executives are going to say, I'm not going to make many $billion investments into new oil supply. Now, maybe natural gas long-term, because natural gas is kind of the compromise, is cleaner. But at these prices, risk reward, natural gas companies are going to start to look attractive when you're $3.
Yeah, natural gas is like down 70%. And I think what's happened is because natural gas didn't have that big squeeze in Europe like people thought it was going to have this winter. So it's probably just a lot of like that coming out of it. But yeah, at this price, it's pretty appealing again, So,
well, I think it's below the cost of production for a lot of companies. So, I mean, it's not going to stay that way for a long period of time.
And like, look at the whole thing about natural gas prices. We know like that spot price is not really realistic because it's all regional. Like what you're paying for natural gas in UK or Germany or
if you're importing LNG, yeah, it's on a long term. If you're importing LNG, I mean, it's very expensive to build an liquefied natural gas terminal, import or export terminal, and then pay for the tanker to carry it. It's super expensive. The capex bills, the cost. Yeah. So, I mean, you're going to try to do that on a long-term contract at some type of profit, or you're going to risk your businesses going out of your companies going out of business.
No, totally. So
okay, well, we've been talking for over 90 minutes now, Dave. I could talk with you for a while, obviously, because we went on some rants here.
And then we should do a football podcast.
Maybe what, the NFL?
Yeah, man, I'd talk about the NFL for an hour and a half. Maybe no one will listen.
I'm pretty shocked the Buffalo Bills laid that type of an egg. I thought this was going to be the year.
Okay, I'm an LSU fan, so it didn't surprise me because Joe Burrow's the man.
Oh, I really respect Joe Burrow. He's a great player, but I mean, like, if the Buffalo Bills were going to do it, the Chiefs were weak this year. They were at home. I mean, they had bad weather.
Dude, the problem with the Bills, again, just to finish, if anyone's interested in this, is even though they're in a bad weather, they obviously play in bad weather. They're not built for bad weather. Their whole offense is around Allen throwing the ball around. And I was criticizing them all year for that. I was like, they need a running game. Like, it's like this is retarded the way they're stupid the way their team is built, because once that bad weather hits, actually it doesn't even give them an advantage because they don't have a really good running game and they want to throw the ball around. So, and obviously, actually, in fairness to Bills, they had a lot of injuries on defense. And I think you saw that show up that last game as well.
Well, Cincinnati had how many during that playoff game? Cincinnati had 3 of their starting offensive linemen out that week.
Yeah, and they still dominated the Bills.
Yeah, you can't fully blame injuries because Cincinnati had even more key injuries on the offensive line. So, I mean, the Bills could. They just didn't show very well at home.
And by the way, I think the Bengals are going to win this week. It's not even because I'm a Raiders fan and I hate the Chiefs. It's it's because Mahomes has a high ankle sprain and he will not be able to run around as well. So
I think the Bengals.
And the Bengals always seem to beat the Chiefs.
Well, no Tyreek Hill there to cause double teams on the defense and open things up. So, I mean, the Chiefs are not as explosive on offense. They have one great receiver, which is their tight end. So we'll see what happens. I think the Bengals have a good shot, but we'll see. It'll come down to which quarterback probably makes the least amount of mistakes and turnovers and is the most efficient. So we'll see. Yeah, I'll attach a link to addictedtoprofits.net. Thank you so much for your time.
Okay, man. Take care.